International Business Machines, a look at the fundamentals behind one of tech's oldest names. Trading at $235.92 per share, IBM carries a $221 billion market cap, a 21 times earnings multiple, and a striking 30.75% return on equity. Why does this matter now? IBM is mid-transition, from hardware and legacy services toward hybrid cloud and enterprise AI. Revenue sits at $67.5 billion, but the real story is margin quality. A 58% gross margin that narrows to under 16% net once R&D, overhead, and debt costs are paid. Start with the balance sheet. $152 billion in total assets, funded by $63 billion in long-term debt, roughly $34 billion in shareholder equity, and a comparatively thin $7 billion cash cushion. That capital structure explains the profitability picture. Return on equity at 30.75% is more than 4 times return on assets at 6.96%. That gap is leverage at work, debt amplifying shareholder returns, for better and for worse. On valuation, IBM trades at 21 times earnings and about 6.5 times book value, pricing typical of a mature, stable cash generator rather than a high-growth story. That leverage cuts both ways. It's tax efficient and has funded major strategic bets without diluting shareholders, but it also means thin liquidity and real sensitivity to rising interest rates. Compared to asset-light, cloud-native peers, IBM's model looks different by design. Lower growth, steadier margins, and acquisition-funded expansion rather than pure organic scaling. The clearest example is Red Hat. In 2019, IBM committed roughly $34 billion, largely debt-financed, to acquire Red Hat and anchor its hybrid cloud strategy. Today's elevated debt load traces directly back to that one decision. So the numbers aren't telling a growth story or a distress story. They describe a disciplined capital return machine, borrowing deliberately to fund repositioning while sustaining shareholder distributions. 5 heuristics to carry forward. Pair ROE with ROA. Check the cash-to-debt cushion. Watch the gross-to-net margin spread. Remember valuation prices durability over growth, and always trace debt back to strategy. All figures sourced from SEC Edgar, CIK 0000-51143. This snapshot is for educational purposes only and isn't investment advice. Thanks for watching.